How much cash is sitting on the sidelines? It's about 6 trillion. So if you take 1% of that, you're looking at 60 billion, and 60 billion is two years of the silver market. And if you believe what I'm telling you, that the stocks are coming down and commodities are going up, don't you think in that transition that 1% of that money will find itself in the silver market? And if 1% of that money is 60 billion, and that's 2 years worth of silver production, where do you think the price of silver is going to go?
Silver has shown its ability to surge dramatically in the past. The price approached $50 twice, in the 1970s and again in 2011, representing significant gains from previous levels. The current event is particularly noteworthy as it is the fourth capital rotation event in 100 years, following essential events in the 1930s, 1970s, and 2000s. Well-known precious metals expert DavidMorgan points out that Warren Buffett's cash reserves could theoretically buy the entire silver market for the next decade. With the silver market valued at around $30 billion, Morgan believes even a small portion of this liquidity could significantly boost silver prices. He also predicts that silver's biggest rally tends to occur after the stock market has bottomed out. According to DavidMorgan, silver's industrial demand has surged from 35% to nearly 70% of the market in 25 years. Despite a rise in production, silver has been in a supply deficit for several years, with Morgan predicting this trend will continue. He emphasizes silver's growing role in the financial system and its potential for significant price movement. With silver supply increasing slightly simultaneously, the supply deficit is expected to narrow to 118 million ounces this year. This would be the fifth consecutive year with a supply deficit and the smallest in 4 years. Regarding silver as a monetary asset, Morgan notes a gold-to-silver ratio of 100-to-1, as silver offers a more affordable entry into the precious metals market. The gold-to-silver ratio reveals a striking imbalance. Miners produce about 1 ounce of gold for every 7.5 ounces of silver, yet gold trades at about 90 times the price of silver, explains Investing News Network. If silver were priced more in line with its production ratio to gold, with gold at $2,000, silver would be closer to $240 per ounce. Even a partial correction of this imbalance could push silver beyond $100. Before diving into DavidMorgan's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
I did a video, probably at least a decade old, called Silver is the Achilles heel of the entire financial system. It's worth looking up. You can go to my blog and probably find it in the search engine, but you probably find it easier just by typing in Silver is the Achilles heel of the financial system, DavidMorgan, or YouTube, and it'll come up. And the idea is what I outlined there. I mean, silver's use in industry has gone from 35% of the market 25 years ago to probably close to 70% of the market now. And in that time frame, the mining of silver has gone from 550 million ounces per year to 850 million ounces per year. So during the time we've increased over 25 years, 300 million ounces of silver coming topside every year. We've also gone from 35% to almost 70, and yet that's with an increasing supply of silver. It's leveled off, by the way. In fact, it's been off a few percent the last few years. And we've been in a deficit, depending on whose study you choose to read, 4 or 5 years consecutively. The idea is that silver does serve a monetary purpose. So again, if you're late to the gold market or 3,500 sounds expensive to you and you haven't participated in this market, then you might consider silver, especially the gold-silver ratio of about 100-to-1. I didn't really expect to see that higher ratio during the last leg of this major bull market, which we are in. Gold is definitely telling us, once it broke above 2,000, which it took a while to do, that the run to gold is on, as I've said earlier. So silver is a way to catch up, but you're going to have some patience. Silver usually doesn't really start its biggest move until the stock market has bottomed. Well, the stock market now is basically rolling over, but it certainly hasn't seen its bottom as far as I'm concerned, from both a fundamental and a technical basis. Your smart money, like Warren Buffett, has moved a lot of cash to the sidelines. As a side note, Danny, this is rather humorous to me, but Warren Buffett's cash position currently would buy up the entire silver market recycling and mining for the next decade. That's how much cash he's sitting on. Think about that. That's just one. It's a big fund. It's a big, and the silver market's roughly 30 billion. So 300 is 10 times. So he could own the silver market for the next 10 years, in theory, of course. But that's just the kind of cash that just one, it's a big entity. I'm not saying it's, a penny stock. It's not. But you get my point. That's just how much cash. Let's look at it a different way. How much cash is sitting on the sidelines? It's about 6 trillion. So if you take 1% of that, you're looking at 60 billion. And 60 billion is two years of the silver market. And if you believe what I'm telling you, that the stocks are coming down and commodities are going up, don't you think in that transition that 1% of that money will find itself in the silver market? And if 1% of that money is 60 billion, and that's 2 years worth of silver production, where do you think the price of silver is going to go?
In the interview, DavidMorgan advises shifting asset allocation from stocks to commodities, particularly gold, as institutional investors lead the gold rally. He warns of global economic contraction and stagflation, which could strain the middle and lower classes. Based on his analysis, DavidMorgan believes we're in the final phase of a precious metals bull market where most gains happen quickly. He warns that metals are overbought and expect a correction. Morgan advises dollar-cost averaging and suggests mining stocks for leverage. He also mentions the sell in May, return after Labor Day strategy could be relevant this year. After reports from the Swiss National Bank, SNB, booked a 6.7 billion Swiss francs CHF profit on the back of its gold holdings in the first quarter of 2025, the Central Bank of Kenya says it is considering adding gold to its reserves to diversify its foreign exchange holdings beyond the dollar and other currencies, Bloomberg reports. Global central banks and investors hoard gold in large quantities, pushing gold prices to new highs. Since the beginning of 2024, driven by factors such as central banks diversifying reserves to hedge against dollar risks and to guard against sanction threats, this precious metal has entered a strong upward trend. Let's get back to the interview.
The biggest thing that the investor should think about is an asset allocation model where it has shifted. It's changed. It's gone from a very long time stocks into now the commodity sector with the monetary metals, particularly gold, leading the way. So there is a momentum shift that's taking place, and it's just beginning. So if you've got a lot of profits in the stock markets or you've got losses in the stock markets, hopefully small ones, take a look at shifting your asset allocation from, let's say, 90% stocks and bonds and 10% metals to something more favorable to metals, maybe 20%. You can still make money in the stock market. It'll be in the commodity sector. So it'll be stocks like foodstuffs, ADM, for example. It could be oil. Oil's very undervalued right now. It may take some patience, but I think oil's a safe bet. And that could rip. If something happened in the Gulf, God forbid, then oil could shoot up, literally overnight. So that's where I would be, but that's the big takeaway. Other than that, the subtitles are the run to gold has begun. As I said over 2 years ago, I think I was the first one to say it, that it's begun and no one's seen it because we're in the stealth mode, but the banks, the smart money, the big money, the cautious money, the money that needs gold as the money of last resort, the banking system is buying gold hand over fist the last couple of years. And now we're into the next phase or second or third phase of that bull market, which means others are starting to wake up to it. Now, most of the move in gold is by institutional investors. It's not by the public. The retail investor is still sitting it out so far, not believing the price movement or not so sure this isn't the top or whatever. But the money that needs to move into the asset reallocation are doing it rather aggressively, and it will get more aggressive than it is right now. And then beyond that, I think it's the shift in the overall global economy that started with the tariffs. I think the tariffs are basically the nudge the market needed to readjust to the new paradigm, which is one, the global economy is contracting, not expanding. And a debt-based monetary system requires expansion in order to survive. If the money supply is expanding and the global economy or the economy at large is not expanding, now it's an even worse condition, stagflation, where you have more and more money being printed and less goods being produced because there's contraction. And this puts a big big burden on the middle class and the lower class because your dollar just doesn't stretch as far. And all of us are feeling it. First, we're in the last major leg of a secular bull market for precious metals. Now, that's not in stone, but the idea is that the final leg up of any market, real estate, stock market, you name it, the biggest move comes at the final leg, the fifth leg in the Elliott wave parlance, or the third leg in just how markets move. Any market can make, but gold especially because it's so emotionally driven. And so it will shake out people all the way up. And that's what you want to be careful of. So you want to plan an attack. And the best way to plan it is to be disciplined and just do dollar cost averaging. I wouldn't recommend leverage for anyone. The best way to get leverage is through the mining sector. If you want leverage in gold, you want to buy gold at 2,500 the ounce. Look for some of the top tier cash-rich unhedged mining companies that we feature in my report and others. I'm not the only one that does this kind of work because these stocks are pricing gold at 2,500, even though we just saw it at 3,500. So if you want to get an edge on those, the best place to invest, and I've always advocated precious metals, physical metal first. I'm not taking that away, but if you're already there and you want to, get back in the market or average down, the best way to do is through the best mining companies. So I think I covered it both. I'm waiting for a breather. The old adage, Danny, which you've probably heard from others, is sell in May and come back after Labor Day. I think that will apply this year.
So, despite gold's continued rise to record highs, silver may emerge as a big investor winner. Analysts predict that gold could reach between $8,000 and $12,000 within the next 5 to 8 years, while silver could also see substantial gains. How do you know the silver market is evolving in the next 5 to 10 years, especially in light of the current economic shifts DavidMorgan discusses? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.